Good day, and thank you for joining everyone today on our Market Outlook and Precious Metals Investment webinar. This is brought to you by Pristine Advisors. We're a public relations, investor relations, media relations, and marketing firm in the industry for the past 29 years, representing companies of all shapes and sizes and backgrounds across the globe. We have with us today several panelists to talk about precious metals investing, and I will now turn this over to Teresa Barros, who will announce our panelists. Teresa?
Hello, thank you. First, we have Maxwell Gold. Maxwell is a Director of Investment Strategy at ETF Securities. He has more than a decade experience in the investment and wealth management industry. Maxwell joined ETF Securities to oversee U.S. investment strategy and research for their growing U.S. business. Next, we have Roman Chuhan. Roman is the President and CIO of Model Capital Management, a company in which he founded in 2012. Model Capital provides tactical investment management services to help advisors improve risk-return performance relative to a passive index. And last but not least, we have Matt Collins. Matt is the Director and Head of U.S. Product Operations and Capital Markets at ETF Securities. Matt has more than a decade of ETF experience and joined ETF Securities to oversee product development and capital market efforts for their growing U.S. business. At this time, I shall turn it over to Maxwell to begin his presentation. So let's welcome Maxwell.
Great, thanks, and thank you everyone for dialing in and joining us today. A lot to cover, so with that, we'll just jump right into it. But really, just taking a step back, wanted to sort of give a broader perspective of where we stand so far this year. More than halfway through the year of 2016. And really seen just a complete reversal in terms of asset class performance so far in 2016 versus the trend we've seen the past couple of years. And in particular for precious metals and other undervalued or other recently unliked asset classes by investors in years past. And you can see if you're looking at slide 5, you can see that precious metals performance as a diversified basket compared to pretty much all other asset classes, developed equities, emerging market equities, global bonds, U.S. bonds, as well as some proxies for broader commodities and hedge funds and private equity. You can see that performance has been very stellar for precious metals so far this year. It's up about 34% as of earlier this month. And really the question is, what is driving that performance? Because this is on the back of 3 consecutive calendar years of negative returns in precious metal space, as well as other commodities and related asset classes. And really, going into this year, flash back to end of last year, 2015. The Fed had just hiked for the first time in over a decade in terms of looking to increase its interest rates of 25 basis points. And at that point, was I think at that point, negative sentiment and net sentiment towards gold, commodities, and other similar assets was at a net negative positioning. And really, since then, we've seen just a complete reversal so far this year with strong inflows into ETFs, strong net positive sentiment in futures positioning for commodities and precious metals, and really just an overall changing of investor sentiment. And there's a couple of key reasons that we're driving behind this. One is obviously just the growing uncertainty in terms of the global macroeconomic and economic recovery that we've seen, not just here in the U.S. but in Europe, Japan, as well as other emerging markets. Secondly, we've seen a lot of mixed economic data come out. Where we've seen strong services and consumer data, whereas we've seen some mixed overall GDP, inflation, and capital expenditure and earnings data. So overall, there's just an unclarity, uncertainty. And then thrown into the mix so far this year, we've had a lot of macro headwinds and a lot of headline risk, including most recently Brexit, as well as a lot of focus on what the Fed will do, potentially continue to hike rates in its cycle later this year. Thirdly, negative interest rate policy and zero interest rate policy continue to weigh on investors. And overall, we're still dealing in an environment where real yields are negative currently. That's essentially taking nominal yields and extracting inflation. And then in a negative real interest rate environment, that bodes well and does for hard assets, for precious metals, as well as for other investments that are great stores of value over time. And finally, we've seen a bit of a range bound of the dollar. The dollar's been very strong really since mid-2014, and it has topped out its peak performance last year in 2015. And so far it's come down. It's a bit down about 2 to 3% so far year to date in 2016. And obviously that's been a boon for not just precious metals but other commodities as well. But digging deeper into it, I think a key overlooked aspect of the rally we've seen in precious metals and other commodities so far this year has actually been the return of the investor and sort of the relative decision making from a asset allocation perspective. So if you turn to slide 6, you can see that this is comparing valuations of equity markets and really where we see interest rates on sovereign debt or government bonds and the trends that we're dealing with right now. And at the top I have this acronym called TINA, which stands for there is no alternative. But I've added a question mark because in our view that we do see gold and precious metals as providing an alternative to traditional asset classes such as equities, which if you look to the chart to the left, on a valuation basis, they seem fairly valued or a little bit overvalued compared to their 10-year historic average. And that's not just the case in the U.S., but it's the case in Europe and emerging markets as well. You'll notice that Japan equity valuations are a bit below their historical averages, but Japan has a lot more other headwinds, and in my view is currently viewed as a bit of a value trap. And switching over to the right, if you look at the chart on the right on this slide, you can see that interest rates continue to be to fall as the hunt for yield continues by investors. Strong demand for yielding securities has put downward pressure on yields and bid up prices. And we've seen in some regions actually interest rates on a nominal basis move to negative, where we've seen that case in Japan and Germany most recently this year. So in an environment where we see equities fairly valued or maybe slightly stretched compared to historical averages, we're seeing interest rates at record lows and negative interest rates globally. It puts investors in a particular dilemma and sort of scratch their head saying, where do we invest, where do we allocate our marginal dollars from here? Equities don't look attractive, fixed income doesn't look attractive. In our view, that's where precious metals and other alternative assets come into play as sort of the other option for investors. And if you turn to the next slide, slide 7, we've seen strong inflows year to date across precious metals, in particular gold, silver, platinum, and palladium. And we do see that regardless of the strong performance we've seen year to date, we do think that there is a strategic role for these investments or for these assets in a diversified portfolio. And really, first and foremost, the reason that we do think that that strategic role is important is because, in our view, we see precious metals first and foremost as a core risk management tool. And this is highlighted on slide 7, if you look here. This is comparing a diversified basket of precious metals performance relative to the MSCI World or Global Equities during particular tail events or risk events in the market over the past 20 years or so. And you can see that, for the most part, precious metals do perform, positively at times when we see large equity drawdowns. Most notably, you can see the 2008 global financial crisis. Precious metals were up about 1%, while global equities had a large drawdown of about 40%. And even most recently, in Brexit in June performance of this year, we've seen a slight pullback in global equities. They've since recovered, but during that heightened volatility in markets, we've seen a flock into safe haven assets and other precious metals, which is why we first and foremost view these in a diversified portfolio as a source of risk management. And it's really these tail events and this tail hedging that continues to serve investors to help dampen their volatility and help manage the risk overall from a total asset allocation perspective. Turning to slide 8. Another key aspect that helps serve precious metals as a core risk management tool is their low correlation to equity markets. And this can be observed on slide 8, looking at it compared to other quote-unquote traditional alternative assets. So what we're seeing is precious metals correlations compared to global equities as well as U.S. equities has been historically low compared to other asset classes that are viewed by investors as alternative assets, such as commodities, hedge funds, REITs, which is a proxy for real estate, as well as private equity. And really, this comes to the benefit because what we do see is that precious metals offer a great source of diversification, not just against equity risk, but against other risk assets. And they really are the true alternative in terms of looking for opportunities to diversify against factor exposure, against portfolios that might be tilted heavily to equity risk, as well as those that are looking for uncorrelated returns to help dampen volatility, particularly in periods that we're seeing of heightened volatility, episodic volatility, and markets being driven by a lot of headline and macro focus from one major event to the next. And we do expect this environment of episodic volatility to continue, particularly in an environment of diverging monetary policies. This should continue to weigh on the macro story and really the direction of the global economy and weigh on financial markets for the rest of the year, as we do see diverging monetary policies where the Fed is remaining looking to potentially hike rates, whereas the ECB, the BOJ, and most recently the Bank of England have been looking to cut rates and remain accommodative. So this spells good news for safe haven assets and other investments that are great diversifiers against traditional risk exposure. So turning to the next slide, slide 9. When we say that, and it's really the low correlation of precious metals in particular, it offers an efficient source of portfolio diversification. And what's interesting about this slide on slide 9 is this is looking at just a traditional stock bond portfolio. But what we've done is allocate 5% from the equity allocation from a traditional 60-40 and have said we're going to invest 5% into precious metals. And what we're doing is we're showing on the left here is the asset allocation across equities, precious metals, and bonds, and really translating that from the asset allocation to the risk allocation. So, dissecting, seeing how much risk contribution or how much volatility contribution is emanating from your different investments. And really, this is where the power of precious metals comes into play in their low correlation, in particular to equity risk. You can see that the majority of risk in a portfolio stems from equity volatility. And it's in an environment where we're seeing diversification being much more difficult to achieve, particularly in a post-financial crisis world. We do see benefits of adding precious metals to help manage not only diversification but overall volatility targets for investors from a diversified portfolio perspective. And you can see that a 5% allocation of precious metals actually contributes less than 5% to your total volatility. That's not the case for equities, where global equities, a 55% allocation on an asset allocation perspective, it contributes almost 94% of your total risk. So your portfolio is primarily driven by equity volatility or equity risk. And where we see opportunities to diversify against that equity risk through other asset classes, and in particular precious metals, as they do tend to have low correlations to other asset classes. So turning to slide 10, you can see that it's really in this particular slide, which is interesting because we're taking the same example of that mock-up of a 60-40 stock bond portfolio and saying, okay, let's allocate from our equity allocation to precious metals anywhere from 0 to 10%, and then at the same time, let's prorate that funding source across equities and bonds. And what you can see is that the one conclusion you can see is that we're seeing an increase of efficiency, which is an increase of the Sharpe ratio, which is essentially just a relative risk-return measure. You can see that as you increase your allocation of precious metals in a diversified portfolio, we do tend to see an increase of efficiency or increase of Sharpe ratio in that. And you can see that what this translates is, regardless of if you're funding your precious metals allocation from your equity position or from your bond position or from both, the one conclusion that we can see that the optimal allocation is never 0% to precious metals. We do see a benefit for investors of different risk profiles, of different asset allocation mixes, to potentially benefit on a strategic long-term basis by holding precious metals in some form in their diversified portfolios. And it's really key in this environment where we are seeing diversifications much more difficult, as I mentioned. We continue to see more and more market uncertainty as we do see concerns around monetary policy, which is remaining accommodative, concerns around a slowdown in key emerging markets such as China, and really, again, a lot of uncertainty from a geopolitical standpoint with the emergence of Brexit this summer, as well as an important U.S. presidential election coming up later this year. All this should continue to weigh on markets, and we do see opportunities to benefit from precious metals investing from utilizing them as a core risk management tool. So if we turn to slide 11. So what we want to do is, we do make the case that, from a strategic asset allocation standpoint, long term there is a benefit from investing in precious metals to help diversify your exposure, to help manage your volatility, and diversify your risk. But really, what we want to address here is some common misconceptions of how precious metals are designated or how they're bucketed across different asset classes. They're most commonly bucketed as a commodity, but what is interesting is looking at different broad commodity indices, you can see that a lot of investors that invest in commodities think that they have exposure to precious metals, and that through their commodity exposures, they're accessing the benefits that precious metals have from a risk standpoint as well as from a diversification standpoint. However, when you crack open each, a lot of the major broad commodity indices, you can see that there's really precious metals are consistently the smallest proportion of each commodity basket index, and most of the exposure really stems from energy and from agriculture. And that really opens up these positions in broad commodities to be very highly cyclical. And a good benefit of what drives low correlation and diversification benefits for precious metals is that they have both cyclical and counter-cyclical sources of demand. The cyclical being primarily industrial use in jewelry, consumer demand, and counter-cyclical being the investment demand, which typically picks up when there's a lot of volatility or heightened uncertainty in markets. And really, if you go across the major indices, looking at Bloomberg, S&P GSCI, Credit Suisse, Thomson Reuters, CRY, you can see that if you're trying to access precious metals by investing in a diversified commodity basket, that's really suboptimal. As really the highest allocation you can get is 16%, which would be on Bloomberg. But even if you translating that into only a 5 or 10% allocation to broad commodities, really puts you at less than 1% exposure to precious metals. So really, we see precious metals as an asset class of their own, and looking for opportunities to allocate to them directly, there is a benefit from that to gain the true benefits that precious metals bring to different asset allocations and portfolio investors. So turning to the next slide, just want to touch on one more slide before I wrap it up. Again, there's a lot of focus on gold mining equities as well year to date, as we've seen very strong performance. Turning to slide 12. We've seen that a lot of I think gold mining equities broadly, different indices, they're up 120, 150% year to date. Really we've seen a lot of our view, a misconception of investors trying to invest in gold mining equities and think that, oh, I'm invested in gold. There is there's a correlation between the two, and obviously the primary earnings source for these companies is through the price of gold. But there are a lot of different idiosyncrasies as well as company-specific and cash flow-specific factors that drive the valuation of mining equities, just like any other company or stock that you would invest in. And we really see gold as being distinct and unique from gold miners in that they do have tangible, consistent risk management and diversification and tail risk hedging capabilities, which hold up over time, which is less clear for gold mining equities. Additionally, gold mining equities, they've been there's a lot of idiosyncrasies, as I mentioned, and for the most part, we've seen an increase of margin expansion, driven primarily by focusing on cost reduction so far year to date, which has been to the benefit. And really, there's a limit to the amount of cost that can be reduced for any given company. Whereas gold, we do see an investment directly into gold as being consistently exposed to the factors that are unique to gold and are less so directly correlated to a company that is in the business of mining gold. And you can see that actually reflected in the performance over the past 20 years or so, where we see really up until the evolution of gold and physically backed ETFs, we've seen the performance move in lockstep pretty much through the 90s and 2000s. But really a true bifurcation or a divergence in the performance in gold price versus the gold mining index. And you can see that that's primarily driven to a lot of concern around overall commodities. There's a lot of negative sentiment in recent years about commodities, miners, and producers. Gold mining companies they don't necessarily mine specifically gold. They may venture into other metals or other commodities as well. So it's not necessarily a direct pure play in gold. And if you're looking for a pure play on the participation in the gold price, we think that investing in directly into gold and other precious metals through ETFs is a great option to get that price participation. And that's less obvious if you're trying to access gold exposure directly through mining equities. But with that, now I want to do is turn it over to Roman, who's going to give his perspective of gold and precious metals and how he utilizes them in his portfolios from a little bit more of a tactical perspective.
Thank you, Maxwell. Good afternoon, everyone. This is Roman Chuyan. Today, I will talk about how we look at gold as part of our firm's approach to tactical management. And in doing so, I will obviously take the viewpoint of us as a tactical manager and the investment advisors whom we serve our clients. And I will highlight the reasons why we like gold right now at this point with our investment horizon, which is relatively short. As a tactical manager, obviously, we maintain a relatively short horizon. So today, I'll try to cover a few things. Number one, I'll explain why at Model Capital Management, MCM, we take a defensive positioning at this time. Second, I'll present a case for inflation protection and why we think that inflation might rise going forward. And lastly, I'll highlight again, echoing Max's, what he covered in great detail, gold as a diversifying asset, why it is so attractive as a diversifier in a complete diversified portfolio. So first, this is a high-level summary of why at Model Capital we maintain a 100% defensive position at this time. Our primary primary model that we use that drives our decision to be in the equity market or risk on, or to be defensive or risk off, is our model for the S&P 500, which basically forecasts 6-month return for the S&P 500 index or U.S. large cap equity market. And that model is negative right now. It has been negative for a few months now, and I will explain a little bit what drivers drive that decision on the next slide. Then, once we make a decision to be defensive, we have to decide what particular specific asset classes to be in. And our models, we have secondary models for each asset class. So their results are summarized on this slide. So our duration model gives a signal to be short duration, to maintain short duration in the portfolio, meaning that we don't want to be exposed to long-term bonds. And it's clear why to most advisors, to most investors, it's because interest rates are so low, as Maxwell also mentioned. Interest rates have been declining for years, for decades, in fact, and they are at an all-time lows and negative or zero in some parts of the world. So the risk-return trade-off in long-term bonds is very unattractive. Bonds are unattractive right now. The only two models that are positive at this time are investment-grade credit model, which is positive, and the gold model. The gold model, the primary, one of the drivers in this model is manager positioning and manager flows, and those have been very positive. Basically, investors have been allocating and moving assets into gold. So that's a primary driver of our gold model being positive. So I'll talk about, at the end of the presentation, I'll sort of show what the final result of this, all of this is, what portfolio we maintain for clients right now. So on the next slide, it's a bit busy. A lot of things are going on this slide, but it basically summarizes the result of our primary model, risk-on, risk-off model, which is the forecast for the S&P 500 index, a 6-month forecast for the S&P 500 index. We are, a tactical manager, and our approach is forward-looking, using fundamentals fundamental factors as part of that forward-looking approach. So as all of investing, we think that tactical management has to be forward-looking, and so we have to have a good idea or an estimate of expected returns for major asset classes. The most important is the stock market. So the current forecast for the S&P 500 is a negative 5.3% return forecast for the next 6 months. So because it's negative, obviously we don't want any part of that negative expected return. Therefore, that's the model that drives our decision to be defensive right now. And again, the drivers, the factors that are included in the model are all fundamentals. What does it mean? That's summarized at the bottom part of the slide. So the model considers over 20 factors, categorized into 3 categories. Valuation is one of the categories of factors, and there, we consider things that most investors look at when they try to determine whether the stock market is expensive or cheap. So the factors include the price to earnings ratio for the S&P 500. We also look at the price to book ratio and other factors. The PE ratio in particular is the largest negative driver in the model right now. And in this valuation category, what our model tells us is that the market is overvalued. It's significantly overvalued, and the outcome, the expected return from that category alone would be around negative 30%. But of course, other factors also matter. Valuation is not the only factor that matters, and we do include other factors such as economic factors in our model. So that's the middle section there, the summary of the economic drivers in the model right now. They, as a group, they give us a positive output, around 24% positive. And that's driven by the fact that here in the U.S., the economy is positive despite all the global concerns and geopolitical and other things that are going on, that the economies that are declining in many parts of the world. We still enjoy a growing economy. Consumer spending is growing at a positive rate, although has slowed a bit, but it's still positive. And some measures of the labor market are also very positive. So those things are combined. Some of those are combined in the economic indices that we use as part of our factors in the model, such as the one that's compiled by the Economic Cycle Research Institute, or ECRI leading index. That's one of the primary positive factors in our model right now. But again, so to summarize, the model considers over 20 fundamental factors, including valuation, including economic. Valuation is very negative right now because the market is overvalued according to the factors that we look at. And the economic section offsets some of that negative effect, but not completely. So the overall forecast for the S&P 500 by our model is a negative forecast, around negative 5%. So that's the model that drives our defensive positioning. So on the next slide, this is I'll try to present the case for inflation protection. We think, looking at inflation historically and at some of the economic factors right now, we at Model Capital think that inflation may rise going forward. Let me just say that this is not a common view. Most strategists and most observers out there still expect inflation to be close to zero or low positive in the U.S. In other developed markets, it's near zero. In the U.S., shown on this chart, this is total inflation. Total inflation rate is around 1%, CPI inflation, and it increased last year from around zero to the current level shown on the right side of the chart, despite the plunge in commodities. I show crude oil price on this chart, and that crude oil price continued to drop last year to the bottom of around $30 per barrel. And despite of that, inflation actually rebounded. So that should tell us that there's some underlying inflation pressures that are at work right now, and inflation is risen last year. Now this year, looking at the far right of the chart, this year, as you know, commodities rebounded, including crude oil, including other metals, of course, precious metals, but also base metals and other non-energy commodities. So we think that is one factor that should, help push inflation up from this point. On the next slide, I show. Next slide, please. I show some of the other factors that might also, provide inflation pressures going forward, including continued rise in housing prices. Housing across the U.S. has been expensive, and home prices have been rising at a pretty, good clip, around the 6 to 8%. In many parts of the country, 8 to 9% year-over-year increase in housing prices. Rents have been rising really quickly. So housing is one of the areas that is, has exhibited nothing but inflation in recent years. On this graph, I show wage growth. Wage growth for people who are employed has rebounded, and it's starting to rise at a good clip at about 3.5% year-over-year, shown by the blue line there. And core inflation rate is still at 2.2%. Core inflation rate. So this is good news for consumers because their wages are rising, and their real wages, net of inflation, are rising now at a good rate. However, that should start to feed back into price pressures in the economy. And on the next slide, now all that was the U.S. Now looking at some other parts of the world, inflation is far from being low in many emerging markets, in large emerging markets, in fact, including Russia. Russia has been struggling with inflation that has been around 14 to 15%. Brazil has seen its inflation increase to double digits, to around 9 to 10%. And in India, even though on this graph inflation has been slowly declining, it stayed resilient. It stayed stubbornly high, still back at above 6% this year. This graph goes back to 2015, but most recent data shows that their inflation in India is back up above 6%. So, looking at inflation around the world, in some parts of the world, it's anything but low or zero. So that's sort of the case for why inflation may rise, or at least continue to be at where it is, or rise slowly. We're not expecting inflation to rebound, but we expect it to be to continue to rise gradually. Lastly, I'd like to mention why gold is such a a good diversifying asset in a diversified stock and bond portfolio. As Maxwell went over some of this in great detail, I'd like to also echo that. So basically, I show here the correlation. So assets which have low or negative correlation with major core asset classes such as equities or bond aggregate are great diversifiers. If added to a portfolio based on their zero or near zero correlation, they reduce the overall volatility of the portfolio. But such asset classes are hard to come by. They're very valuable if they exhibit that low correlation property. They're not, we don't see many assets like that. For example, some of the asset classes that are non-core assets, including high-yield bonds, loans, treasury inflation-protected securities or TIPS, they have a relatively high correlation to the S&P 500 in case of high-yield bonds and loans, over 70%. TIPS, if we are of a view that long-term bonds are unattractive, which we think they are, they present really high risk. If interest rates start rising from here, investors might get burned on long-term bonds. Then TIPS are not good either because they are highly correlated with long-term bonds, with Barclays aggregate. So the only asset class on this exhibit that exhibits a low correlation with major asset classes is gold. It has zero correlation to the S&P 500 and near zero to a 60-40 mix of stocks and bonds. And even the correlation with the Barclays aggregate is the lowest out of all these asset classes shown here, around 0.3 or 30%. So gold is a great diversifier in the diversified portfolio because of that low correlation with other asset classes. And the last thing I want to mention is on the next slide, what asset classes we actually invest in right now in our portfolio. So this is our complete market portfolio, which is a moderate tactical growth, you might call it. We have three, and this one is in the middle in terms of its risk. And we are basically primarily in short-term corporate bonds, 80% in short-term corporate bonds. But stepping back again, because our primary model gives a negative forecast for the S&P 500, we don't want to be. We are maintaining a 100% defensive position. So we have zero exposure to equities at this time. Short-term corporate bonds are attractive primarily. They don't provide nearly as much return, but they're basically a defensive play. And we are earning a bit of a spread over treasuries. Treasuries, 2 to 3 year treasuries provide very low yield, about 0.7% right now. But adding corporate spread to that, we get to about 1.5 in yield, and that's at least that helps pay the fees, so to speak, for advisors. And then we have 20% exposure to gold, which consists of ETF securities product, ETFS physical Swiss gold, 10% in that product, and another 10% in the other provider of physical gold exposure. So that completes my presentation, and with that, let me turn it over to Matt Collins, ETF Securities Director. Thank you.
Roman, thank you. Maxwell, thank you. Those were both fantastic presentations. Just a reminder, in a second here, we're going to turn it over to questions for everyone. So there is a dialog box that will allow you to punch in the questions. Roman and Maxwell will stick around and we'll get to as many questions as we can. We've already seen several come through. Before we do that, we do want to highlight a few of the ETFs that ETF Securities offers here in the U.S., particularly the ones that relate to some of the messaging and strategic positioning that you've heard from our panelists today. So quick background, ETF Securities was the founder of the first gold ETF in the world. Currently we manage about $23 billion globally. And on the page in front of you, we've highlighted some of our key funds that relate to the presentations you've seen today. So our precious metals ETFs that collectively have about $2.5 billion in U.S. listed ETF assets. The two that I do want to highlight, because we spent a lot of time talking about gold today, is our gold ETF, SGOL, S-G-O-L. That is the only ETF in the U.S. that vaults in one known specific location. And that is absolutely by design based off of client feedback. So as we talk to clients, we've been here in the U.S. since 2010. The entire premise of gold is knowing exactly where it is and that it's physically held. So in times of stress, you have that reassurance of where it is. So we've chosen to vault our gold in Zurich, Switzerland. A lot of the other ETFs are either synthetic, and then a lot of the popular ETFs out there vault in locations across the world. So I think our differentiating factor for SGOL is that we vault in one known location, and we've certainly seen a lot of interest and crossed $1 billion this year in that particular product. But from a lot of the advisors that we talk to, and this relates to some of the advice that you heard from Maxwell, is our glitter product, GLTR, which is the only product ETF in the market that holds all of the metals in one ETF solution, so gold, silver, platinum, and palladium. From our perspective, if you look at gold, I think that's one of the most well-known and understood investments really in the history of investing, really. But outside of people that have taken an alternative choice in their wedding band, there's not a lot of understanding in platinum, palladium, and silver. So if you think of gold as sort of your safety net with two levels of demand in defensive positioning and jewelry, silver, platinum, palladium, as you go across those metals, the cyclical industrial component really increases, particularly in platinum, palladium, where the vast majority of demand does come from industrial pollution abatement in terms of using in car parts, particularly from emerging market economies in China. So when you combine each of these metals together into one ETF, most importantly, you're getting an allocation to precious metals in general, so you're getting the beta of that class. But rather than holding an individual metal, you're getting a much smoother ride when you combine some of these metals that act a bit differently over time. So each of the products are here on the page, and I think, Teresa, if you are ready, and I see quite a few questions come in, and I'll turn it over to you to pose questions to Roman and Maxwell.
Okay, thank you. Yeah, we have quite a few questions. We can start off with, what is your favorite precious metal stocks?
Yeah, I can go ahead and field that one. So I'm assuming when you said precious metal stocks, correct?
Yes.
Our position is that we view precious metals companies like mining companies, gold mining companies, and others as such. We primarily view them as equity investments, and you can really see that translate in terms of their risk-return performance. And really, from our perspective, we don't favor one company over the other. We don't have a set particular view. Our perspective is that there's specific factors, specific beta exposures that are unique to physical gold, silver, platinum, palladium in terms of the price performance, driven by core fundamental drivers that is distinct. It might be related in some market environments and over certain distinct periods to the companies that mine these, but we do see a distinct difference. And we would say that if you are looking for direct price participation in the price of gold, the price of silver, or the price of overall precious metals to be a complement to your asset allocation, we would say they will look towards a direct investment in the physical market from our perspective. As I went through, there is a distinct difference between mining equities and, say, investment directly in the price of precious metal. Because at the end of the day, the value of a mining equity is determined by the profitability and the operating costs and the earnings of that specific mining company.
Okay, great. Next we have, how many ounces of gold are there per futures contract?
I guess it depends on which futures contract that you're referring to. The most common contract for U.S. investors is the COMEX gold future, which is a 100-ounce bar futures contract, and I believe there should be about 100 ounces to that specific contract, and it varies depending on which futures exchange globally that you're dealing with, and there's also smaller mini futures contracts, so it varies. There's a lot of different contract sizes to meet the different global investor needs.
Great. Next is, what are silver leasing rates?
That's a great question. I don't have the specific number on hand. Definitely, if you can have the person reach out to us via email after the conference, happy to help put some further context and a specific number to that.
Okay. We have, why are silver futures shorted so heavily by major players?
So again, we're actually seeing net record long positioning in silver contracts. The reason that silver and other precious metals are usually hedged by producers is because they naturally take a long position in the metal or the commodity from their business operations, and they want to try to lock in their pricing. And a feasible way for these companies to do that is through the futures market.
Okay. Next we have, what is permanent backwardation in the gold futures market, and how does permanent backwardation affect global markets?
Roman, do you want to take a stab at that one?
Sounds like a quiz. Permanent backwardation, I would say this would be related to like storage costs for physical metal, for physical gold, and so that would, I think, whatever the storage costs are, it would be probably would permanent backwardation would be driving that it would be driven by the storage cost. That's the best sort of answer. Sounds like a conceptual question, but that's the best answer I could give. I mean, then in the market, it sounds to me like just a conceptual thing. Whatever that is, permanent backwardation. Then in reality, we can see what it is, whether contango or backwardation, whatever the current market shows. The futures with different expiration dates, maturity dates. It can trade in contango, it can trade in backwardation at any point in time. That's varies widely over time. When gold was rising in the bull market, that sort of ended. That began around 2008 and ended in 2013. As I recall, most of the time, gold was trading in contango because that's driven by market expectation of where future prices are going, and the reverse should be true for when gold was in a sort of bear market from that point, from 2013 until about a year, last year. So what you see in the market, my point is, can vary greatly from permanent or theoretical backwardation.
Okay, great. Next we have, why are central banks close their short positions and open long positions in the gold future market?
This is Roman. I can sort of speculate. My opinion as good as anyone else's, but central banks are, they don't broadcast their intentions when they buy or sell gold for their reserves. I think it is. I think it is driven by the view of global central banks that where things are going with, what we've had with central bank monetary stimulus in, things since 2008 until last year was basically, a large infusion of liquidity into the system, and then then banks started started buying ETFs like they are in Japan. They started they bought bonds all along, and then the Fed stopped buying bonds, but other central banks are still buying bonds and providing that liquidity. I think countries are viewing that as a these trends that are might likely to end badly, and so gold is viewed as a stable asset. It's viewed as a hedge against things going really something bad happening, basically. The other thing I can sort of comes to mind is that some countries are large holders of gold and others don't have as much, and they would like to increase that just because of their their share of their reserves invested in gold is not that high. For example, what comes to mind is Russia, for example, and others are probably have tried to increase their share of their reserves that they want to invest in gold.
Great. Next, we have a question from Max. What are the main sources of demand that would help the various precious metals maintain their momentum through the rest of the year and beyond?
Yeah, that's a great question. I could go down the line just real quick. So starting off with gold. So what people don't realize is gold gets caught up in a lot of investment flows, investment demand. We've seen very strong inflows into gold in Western countries, particularly U.S. and Europe, so far this year. But what a lot of people don't realize is that actually more than 50% of annual demand for gold comes from the jewelry sector, which makes a lot of implicit sense. And a lot of that actual demand emanates primarily in emerging markets, particularly India and China. So we're looking for continued strong consumer globally, as well as continued strong investment demand, which we do expect given the macro backdrop that we've went through in this webinar of continued macro uncertainty, mixed economic data, as well as diverging monetary policies, to be a continued boon for investors looking for store value diversification, as well as a risk hedge for gold. For silver, silver again, very similar to gold. Investment demand is particularly important, but to a more of extent, industrial demand. So as we do see the global economy continue to stabilize and pick up, we've seen a bit of a sluggish recovery in past couple of quarters, but directionally we are still seeing the global economy moving in the right direction. So as we do see more industrial production pick up, we should see added demand for silver, particularly in other emerging markets as well as other developed markets. And on the investment side, we do see strong continued investment demand by U.S. investors as well as Indian investors in silver. And platinum and palladium, are actually much more exposed and levered to the auto industry. They're key inputs for auto catalysts, which are help in emission and fuel standards of pollution for global auto sales. So they're a key component in engines, and they vary regionally. So palladium is much more levered to gasoline engines, so they're primarily used in Chinese and U.S. consumer markets. And for platinum, it's much more concentrated in European auto markets. So platinum's used for auto catalysts in diesel engines, which is primarily concentrated in Europe. So as we do see, again, the continued industrial production, improving economic backdrop, higher wages, more consumer spending, higher consumer sentiment, these factors should play into more demand on these other precious metals. But overall, again, we are still seeing a strong demand and very robust, constructive outlook for the entire space.
Great.
There's also, if I might add, just briefly, there's also a counter-cyclical argument for precious metals and demand for precious metals. So if things don't go the way of growth and industrial demand, and if that, if the global economy, in fact, continues to deteriorate, and especially if we get some, significant volatility in capital markets, gold and other precious metals are viewed as a diversifier of that against that volatility, so that should support continuing demand for gold. Also, there's been a change, there's been a tectonic shift, really a significant shift that hasn't happened in as far as I can see based on historical data. Hasn't happened for decades, really, and that is what happened to bonds, to the bond market. The fact that that bond yields dropped to zero and now to negative yields in many parts of the developed markets. Really, now what we have is a situation of that presents a challenge to asset allocators, to managers who take an active approach and look at whether they want to be invested in equities and what is the alternative. It used to be bonds. Bonds were the alternative to equities and the asset that was diversifying and performed well at the time of the equity market declines. That's no longer that might no longer be true if both bonds and stocks look bad at this point. And so gold and precious metals, they are the only game in town, if you will.
Okay, great. Okay, next for Roman, we have in your presentation you refer to two inflation numbers, 1% and 2.2% core inflation. What's the difference and what's the true U.S. inflation rate?
Sure. So total inflation, consumer price, both are based on the consumer price index, or CPI, which is based on a basket of goods and services that is considered typical for U.S. consumers. 1% is total inflation, and the other number is what's called core inflation rate, which excludes volatile food and energy prices, because they are volatile. So, so that core inflation rate, excluding food and energy prices, is around 2.2% annual rate, which is far from low. It's actually over 2%, and it's close to the Federal Reserve's target inflation rate. But the Fed looks at core inflation, which again is around 1%, as because it's more stable, and it's not. And the reason core inflation, sorry, the Fed looks at another measure, but the reason that total inflation is lower than core inflation is because commodity prices have been so low. They dropped, really plunged significantly in the past year and a half or so, since starting in 2014, and so that's what drove total inflation, which includes energy, down to 1%. That's why total inflation is below core inflation.
Great. So if inflation is 2.2%, does it mean that it's reached the Fed's target of 2%? And if so, why hasn't the Fed been concerned about it?
The Fed uses yet another measure of inflation, which is based on the same data, economic data where the GDP is reported. They use personal consumption expenditure price deflator, or PCE inflation. They use core PCE deflator as their preferred measure of inflation. So again, they look at core inflation, which excludes volatile commodities, but instead of the consumer price index, instead of CPI, they look at a more, it's a slightly different measure, core PCE inflation rate, and that rate is around 1.6% at this time, although it's reported with a bit of a delay because it's reported on the same cycle as GDP. So it's 1.6. That number is below the Fed's target of 2%.
Okay, and we have one last question for today. How long do fiat currencies typically last once they have abandoned a gold or silver backing?
I'll take a quick stab at that one. Currencies will probably last for a significant period of time, and you know, the concern is there. I mean, the current currency regime has been in place since, you know, I think 1974. You know, post-Bretton Woods system. So it's been in place for you know, about 40 years, and the real question to investors is not whether, you know, that the current system will end badly. It might, but a more important question is when, is a time frame, and that's more important, and that's really challenging. So, you know, to an investor, a more relevant question is what will happen in the next year or so. Let's say, if they are you know, have a tactical mindset and would like to change their asset allocation based on where things are going in the near term. If they are long-term investors, they might look at 5-year or 10-year horizon, but still, you know, it is very, very likely that the current currency regime will continue in that over a mid-term period of time, let's say 5 years. So it is really, it's kind of a tricky thing for investors. I mean, we are also concerned. Other people expressed concern about these things, the currency regime and so on, and they might be right. But the question, you know, it might eventually end badly. But as long as it continues over the midterm, we want to be invested in the asset classes that give us the best expected return and risk.
Great. So I believe that will wrap things up for today. So at this time, I would like to thank Maxwell, Roman, and Matt for a very informative webinar. And I would like to remind our audience that this event does qualify for 1 CFP credit. So for anyone wishing to receive credit, please email us at events@pristineadvisors.com. Thank you all for your time and have a good rest of your day.